So, all welcome back. And now we're going to talk about the risk subject. And it's key. So we're going to split this, Angelina. You're going to
Yeah,
introduce yourself, go through the first couple of modules.
yeah.
I'll go through the other modules and wrap it up. And hopefully we will get you out by 12:15. And so hand you straight to you, Angelina. And
Great.
you're very welcome. Great to see you.
Thanks a million. Hi, folks. How are you? Welcome to this morning's induction on credit risk assessment. I'm Angelina, your tutor. So I'll be guiding you and supporting you as best I can through this wonderful module of credit risk. So I'll just briefly tell you a little bit about myself. I'm currently working in the Public Service Credit Union, and I've been actively involved in credit control for nearly 10 years. I came on board with Declan as a credit tutor back in 2019, and I absolutely love it. I thoroughly enjoy seeing students like yourself, say, starting off or having completed part, succeeding in the diploma, but in particular, this module, because I think out of everything, it probably is the most challenging for most people. I did complete the diploma myself back in 2016. It was a challenge, but as I said, I absolutely loved it. And for me personally, I felt it gave me a newfound confidence when working in credit control, but just overall with my whole work ethic, from just understanding accounts, simply being able to understand our AGM booklet, the balance sheet, bad debt provisions, then dealing with difficult customers, and then just improving our collection techniques overall. And if you'd said to me that I'd be a tutor sitting here right now chatting to you guys, I definitely would not have believed you. The one thing with the credit risk assessment, I don't think there's any way of avoiding it. I think it's very important to have an understanding of credit risk on the whole. And I'm going to repeat this a lot. What we're looking for from yourselves in this module is to get an overall understanding of credit risk. Um, like credit control is not just about collections. Like there's other areas. It's good to know who we do business with, and how we do business with them. So I very much think that credit risk is maybe the basis of credit management overall. And the more areas that you guys know as credit professionals, the more you'll get paid. Okay. So we have four modules within the credit risk. And I'll just warn you, and Declan has said it as well, that they are accounting based. Okay. So it is important that you have an understanding of what a set of accounts are and what they look like. So I don't know if any of you are accountants or are looking to be accountants, but the main objective, as I say, overall is to know and understand what the set of accounts are, what they look like, where the money goes to, and where it comes from. And I just find with this module in particular, people tend to overthink it. They get themselves worked up. It's very much new material that you mightn't have seen before, so it can be a little bit daunting. So what I would say is just be patient with yourselves, and take things step by step, because the accounting part is a step by step process. We tend to jump way ahead, so we go from 1 to 10 and forget that there's, say, 9 steps in between that. So again, it's understanding the accounts, what they are, where they go. And once you get the hang of it, then that'll lead you into your second, third, and fourth module. Okay. There obviously is a certain amount of knowledge that you'll need. I'll actually share the screen now. Away. I'm still learning as a tutor, so even on the other side, it's still getting to grips with everything. Okay, so as I said, there is a certain amount of knowledge that you will need to know. Okay, but there's no need to be getting hung up on, say, debits, credits, what they're, all that kind of stuff. The information is there to explain to you how everything fits together. Okay, so module one, we see there it's the introduction to accounting. So it gives you an overview outlining of what the different terminology is, what the concepts are, the language, the rules, how things are applied, and then it's looking at how everything hangs together. From a terminology point of view, I don't know if any of you have studied accountancy before. They have, Declan, you can maybe add on this, it has been standardized, the terminology, isn't that right?
Yeah.
Yeah. So say anybody that would be familiar with profit and loss, this is now called the income statement. Okay. And then but it's the same information. Okay. And then for say going to module 2, the income statements, that's the preparation of your account. So you'll see the statement of financial position. That's a new name for the balance sheet. Okay. So the income statement then, that'll tell you what a business has bought, what they've sold, what expenses were involved in the business, and did they make a profit or did they make a loss in a period of time. So income statement, we say, is for a period of time from January to December. And then when you're moving forward to your balance sheet, we'd say that that's an overall snapshot listing everything that the business owns and everything that you owe in a moment in time. Okay. So once you understand that the income statement is all of the transactions within the year, the balance sheet is your snapshot at the end of the year, then you're halfway to getting there. Okay. And I know, Declan, you kind of tend to describe things in a kind of past, present, and then looking towards the future. So you could say your income statement is what's in the past, your balance sheet, your snapshot is the present, and then the future is what you guys are interested in. It leads you then to module 3, which would be your cash flow forecasts. So that helps us work towards the future and seeing, can a business pay their bills? Is that okay? So that's an overview of module 1 or 2, your introduction to accountancy, how the format is laid out, and like it doesn't change, it's the same. So once you get the hang of it, it's just practice, practice, practice. Okay.
Brilliant. Okay, so I'll just stop your screen there, Angelina,
Yeah.
and I'll go into my module 3. Um, so
If there's anything you
so
want to add there, Declan, to that,
yeah, I think
feel free.
yeah, I suppose what the few things I would add, um, because I know. Well, you see, I'm different. I spent my whole life working in credit management, and I spent my whole life reporting to accountants, and they left scars. So I'm kind of biased on this, you know. And the one thing I think you have to know and realize is that accountants and credit people are the exact opposite to each other. And accountants just don't get credit management. It because it keeps moving. They like things that are fixed. So and we like things that are fluid and moving. So there is a disconnect because we end up reporting to finance, and because, as I said, somebody throw a set of accounts and say, will you give them 50 grand? We have to be able to understand it. We have to be able to speak the language. And that's really module 1 and 2. So again, I know when you're going through this, there is a lot of stuff. There's a lot of accounting phrases and work. What we're going for here, guys, is an overall understanding. We know that most of you are not accountants, and I know that most of you never want to be accountants. You still have to know the language and understand it. So stick with module 1 and 2. Module 1 and 2 shows all the sort of the transactions at granular level. It's very, very detailed, and hopefully we build up from the individual transactions to the individual accounts to the consolidated accounts to the annual accounts, and show you where all the information comes from. And your assignment, I'll give this away as well, your assignment for your first assignment in accounting is you will be given a whole pile of transactions that happened in the business over a period of time, and you will have to extract all the information and produce a trading profit and loss and balance sheet from the information you're given. And you're not just given information, you're also going to be given adjustments and changes and depreciation and accruals and prepayments, and it all might sound very, very confusing. When you get to it, it will be easy. And even if it's not easy when you get to it, because we have our revision session on the 5th of November, we will go through to make sure everybody, we leave nobody behind. And sometimes halfway through module 2, some people throw their hands up and go, oh, I don't get this at all. Stick with it. The penny will drop, I promise you. And
You'll have a
all of
light
a
bulb
sudden,
moment.
isn't it? And you go,
Yeah,
ah, yeah, now I see. And
yeah,
and that's and I know, Angelina, for you and for me as a tutor on this subject, that's the magic moment that keeps us doing what we do. When somebody just goes, ah, yeah, and it's like somebody switched the light on, and it is great, you know.
yeah.
So stick with module 1 and 2. I know they're heavy going. Um, you don't have to learn all the terms off by heart. That's not what we're looking to do. So in terms of your expectations for yourself, it's just to know and understand the phrases. And in terms of the explanations of the terminology, I know there's a good few pages in the notes dedicated to that. That's
Yeah.
just for your information. And you can keep your notes to refer to them. If something crops up at a later stage, you can go back and refer to them. You don't have to learn them all off by heart. So just understand them, get at a top level. Are you with me? And then your first assignment is to produce a trading profit and loss balance sheet, and on that basis, that then becomes the basis of your risk assessment. So once we can do that, we understand all the component parts, we understand why accounts are adjusted, we understand the concept of fixed time and all that kind of good stuff, and then we're ready to move in. So module 1 and 2 is up to trading profit and loss and balance sheet, and then module 3 and 4 is what we do with that information. Are you with me? So Angelina mentioned about the 3 phases. So the past, the present, the future. So the future is your cash flow forecasting. So how do we forecast cash? So by looking at our terms, by looking at our cash receipts, by looking at previous history, by looking at expected payments, we can, and if we have sales budgets going into the future as well, we kind of know people pay us on the last day of the month. Well, 80% of them do anyway. And we're going to sell 1 million in February next year, so we should be getting 800,000 by the 28th of March. So we can, if we know how to extract the figures, predict accurately what's going to happen in the future. And understanding cash flow forecasts and cash flow statements, you might be doing it already. This will give you a kind of a background knowledge from an accounting perspective as to how to do it. And even if you have this fear that, oh, cash flow forecasting is for the accountants, no, it isn't. Because they don't have a clue. I've told you that already. They don't have a clue. They look at the cash flow requirements based on the expenditure requirements, so how much money they have to have in the bank to pay the bills. We have to look at it from a source. You tell me to collect 4.7 million. Hold on, there's only 3.2 on the ledger. I can't get 4.7 million. It's not there to collect. So accountants do look at silly things because they are looking at it at the opposite way. And if you give an accountant 4 pages to file, and each of those pages, one has 1, 2, 3, and 4 on it, right? The accountant will have 4 on the bottom, the credit person will have 4 on the top. We just think totally differently. And that's why, you know, there will be areas of confusion, and I want you to get beyond that. So working capital, that's what we do in credit. You know, we might see ourselves in collections and credit control and risk and all that sort of stuff. Really, we are the manager, so we have to understand working capital. We have to understand the implications, the money coming in, the money going out, and all that kind of good stuff. And then once we get to that stage, now we're into analysing. So it's not just doing financial statements. You've done that in module 1 and 2. Module 3 then, we go into analysis. So we look at the accounts and we think, and how I like to think about this, and hopefully this will help you too. When I look at a set of accounts, I am not looking at the numbers. What I want is the story that those numbers are telling me. So what is the story these numbers are telling me? So if we're looking for the story, so by understanding all the numbers and where they come from. So for example, I can tell, well, hold on a second now. You know, their purchases in the P&L account is 120,000. Yeah, so I can see that figure over there. I can also see in the balance sheet they have a creditors figure of 60 grand, so that's what they owe to their suppliers. Yeah, hold on a second. If their purchases for the year were 120 grand and they still owe 60 grand, they have only paid for half their purchases for the whole year. These brats are taking 6 months credit. Yeah, so I can see that by combining the numbers that are here and are there. I know if their sales were, 2.4 million and they're owed, 800,000, right? It's taken these guys 90 days to get paid because they're owed for a quarter of the whole of last year's sales. So I can tell from a business how quickly they're paying their suppliers, how quickly they're getting paid from customers. I can work out, I can see, and we talk about working capital management. Working capital is the money you have to play with on a day-to-day basis. And to me, I tell you something else. The accountants will disagree with some of the stuff that you'll learn on this course as well. For example, I'll give you one example of where we give you the total opposite advice to them. So if I was in accounting school and I'm looking at ratios, and we will be doing all that sort of good stuff as well, looking at ratios, they will say that the higher the creditors ratio is, the better. Because they think that, look, it's better to have a creditor, somebody that you owe money to, and then have money in the bank than giving your money out to all your creditors. So that's accounting brain. Credit management brain is, I love people who pay their bills on time. So I want to see people who are paying, who have low creditors. So the accountants will tell you, no, high creditors is good. I'm telling you, from a credit perspective, low creditors are good because it means these guys pay their bills, and I like people who pay their bills. Do you understand where I'm coming from? And
Yeah, I've seen it
accountants in
before. Yeah.
general as well, accountants tend to look backwards. So accountants are, when they look at a set of accounts, they're analysing the last 5 years. I'm a credit guy. I really don't care what happened in the last 5 years. What I care is, can these pay me next month? And the month after, and the month after that. So we're looking forward into the future, whereas accountants tend to look back at the past. So when we understand all our accounts, what I now want to do is to say, well, hold on, all other things being equal, if they sold 100 grand last year, 120 grand, 120 grand 2 years ago, 150 grand this year, the business over the last 3 or 4 years has been growing 10% year on year. So it's not a sort of a jump to assume. Probably. And now with a combination of a drop in volumes that we're going to experience, because there is a recession coming whether we like it or not. So a lot of the drop in volumes will be counteracted by an increase in price. So even if our sales are the same this next year as this year, our volumes will have decreased and our margins will have decreased because our expenses are going up. So it's knowing how to read the figures and to make predictions about the future. And that's what we're talking about when we get into analysis. And ratios, again, people glaze over with ratios. To me, ratios tell you the story. How quickly are they paying? How quickly are they getting paid? How profitable are they? Are they making money? Are they solvent? Can they pay their bills? So that's why the three things that we look at is liquidity, the ability to pay their bills, profitability. If they're not making a profit, now they could be zero for a while, and they can dip, they can lose money for a year, and maybe next year a lot of companies will lose money. Certainly 2020 with shutdowns, everybody lost money. So for some that's terminal because they can't survive. For some it's a blip and they bounce back. And I suppose the trick of being a good credit manager is to know the difference. So the ratios, yes, there are formulas, and guys, you don't have to remember the formulas. The formulas are in the notes. You'll have the page on your desk when it comes to the exams. So you don't have to remember them. You do have to understand them and be able to apply them and to come to a sensible conclusion at the end as to whether... So we'll give you scenarios. Would you give these people credit? These are their last 3 years' accounts. And you decide yay, nay, or maybe with caution, or maybe with security, or whatever the case may be. So that is that. And the other thing that will drive accountants mad is that, if you look at even the business news, the two things that people look at from an accounting perspective is sales or turnover or revenue or whatever word you want to use for that. So their sales figure and the profit figure. So that's the two things. So they report on profitability, they report on sales, they want to show growth and all that sort of stuff. The reality is, guys, you can have growing sales, you can have growing profits in your P&L account, and then on your balance sheet you have this debtors ledger that's getting bigger and bigger and bigger. So while yes they are selling and yes they are showing a profit, if the customers aren't paying them, that's a recipe for disaster. And what's going to happen and why companies go bang is they run out of money. And that's something, so in all the ratios, I am going to tell you that the most important ratio is the current ratio, the difference between their current assets and their current liabilities. And you can't say, that's only 1 of 20. Yeah. And to you, it's 1 of 20. To us, that is the most important ratio. Oh, what about the net worth in the balance sheet? What about the net worth in the balance sheet? You know, they could have £1 million premises and Ferraris as company cars. So the assets of the business look huge. If they don't have the money to pay their bills when they fall due, that business is going to fail. So I'm not impressed by net worth of a business. I am impressed with the difference between what they own and what they owe and their ability to pay their bills. So, you know, I just want to get that out of the way, that it is based on accounting, it is not accounting. So liquidity is the most important thing, their ability, and you will be able to determine what's liquidity, what's profitability. We'll give you half a dozen. Now there's 1,000, you can go through accounting books and find 1,000 different ratios. I have 12 that have served me all my life, and that's all I need to come up with a system for business. So that's the analytical and interpretation of accounts. And then we move into credit scoring. So you will have your own scoring models where you will be able to score businesses, and there's comparative scoring. So a comparative analysis is where I can put 2 or 3 companies in the same industry and score them to see which is the best and which is the worst in that industry. So it gives you sort of an insight, particularly if a new customer comes on board. Oh God, he's better than our best guy, I love him. Or God, he's worse than our worst guy, you know, we need to keep a close eye on him. So it'll just give you an insight into them. Now, the other thing, just in case you're getting carried away, that look, I know you only have so many hours in the day. You're not going to get to analyse accounts for every single business, and because we have more important things to do. What I want you to do is to, within the credit management module, to set up your rules and procedures, and then if there's significant exposure or significant balances, then, you know, and again, it depends on the business. I was talking to one company who was talking about instigating legal action for collections, and they said, well, they wouldn't deal with small amounts. And I said, well, what is a small amount for the purposes of legal action? And they said anything under $1 million. And I went, oh, so how can I have a 900,000 account with you, please? But anyway, so whatever's a significant figure. Z scoring, I'm not going to, you're going to have to learn it. So risk management then, so how we classify risk. So part of our management of credit is to assign, so this is a low risk, this is a medium risk, this is a high risk, and then we can apply our credit policies based on the risk factors within the business. So if it's a blue chip company who has been around for 100 years, you know, they're probably going to be around for the next 100. If it's a coffee shop, you know, they spring up and vanish just as quick. So we need to be clued into risk, and particularly over the next 6 months we need to do that as well. And then in terms of establishing best practice, we can do that through the comparative analysis once we know how to do it. And the good news is we have formulas, we have calculators, we have spreadsheets for you that you can bring to your office and work once you understand what's going on. And then obviously, because we're looking at risk, we're looking at bad debts, so bad doubtful debts. So, you know, provisioning is something that's very important to me as well, because look, of course we're going to have bad debts, that's a given. If we have sufficient provisions in the accounts for the bad debts, then nobody dies. All right. If you fail to provision and the bad debt then hits the profit, then that's going to hit the headlines and get you into trouble. So we need you to understand your provisioning, your bad and doubtful debts, how to measure them and the cost of them, and then how you can build up reserves against them if and when they do happen. So that is that. And then looking at business failure, so the warning signs, and hopefully you'll see these, and we're looking at payment patterns, we're looking at, talking about coffee shops. I'm looking at TripAdvisor. Like if they score a 5-star on TripAdvisor because the coffee's lovely and the staff are great, then chances are that coffee shop will still be around in 6 months' time. If they're getting 2 stars because the coffee's cold and the staff are rude, they're not going to be around. So it's not just about financial analysis. I need to look at the whole world because I'm living in the whole world and say, well, hold on a second now. Am I happy giving these guys credit? No. And will I refuse the order? Of course I won't. But if you want stuff, you have to pay cash up front or on delivery or whatever's appropriate to your business. So we'll set out the red flags for you that you need to be looking at in terms of warning signs. Because a lot of times when companies fail, they have given clues. There have been return direct debits, there's been failed payments, there's been broken promises, there's been hard to contact. There's loads of little clues that you get, and any one of which can be reasonable. When you get them all together, it can just be a big red flag. So we want to show you those as well. And then, even though in the third module we tell you how great ratios are, in module 4 we tell you that they're not the be all and end all. So there are downsides to ratios as well, and we'll show you how some companies play around to manage the ratios. Are you with me? So they might sell off a big asset to generate cash to make themselves look solvent, and there's games they can play that I want you to be wide awake and know what the games are, and to see that as well. And failure prediction. So there is this thing called an Altman Z-score, and it's funny because Edwin Altman, and I believe he's still alive, I can't believe it, because I learned about this stuff, I won't tell you what decade. He came up with this back in the 60s. And I did some research on him recently, and he was still alive. I think he's in his 90s now. So Edwin Altman is his name, and he came up with this Altman Z-score. And the Z-score is a predictive insolvency score that if you apply the different ratios in a set format, you can tell how long a company has to live. So, these kinds of things are good to know and to have them at the back. Now, the problem is with a lot of this is that if you're relying on agencies and all those kind of good people to give you information, you'll be paying Dun & Bradstreet a fortune for a set of financial accounts for a company, and they're 2 years old. So sometimes it can be too late. So getting up-to-date information, that's something we get you to do as well. And then the final thing in Module 4, overtrading. And we see this in times of economic boom. So the gas thing about it is that in a recession time, when businesses close and a recession comes, it starts to bottom out in terms of failures. And when the business picks up, the failures increase, not decrease. So when we come out of a recession, we see more failures than we do going into a recession, which is ironic. And it's because of this overtrading. They're grabbing every order they can get. The business is growing, everything looks rosy, and then boom, they just run out of money. They overstretch themselves and they can't get themselves going. So it's knowing and understanding that you can sort of see down the road in terms of what's coming down the road at you, that you can take appropriate action early enough to make sure that you minimize your losses at the other end. You're never going to eliminate your losses. That's not what you're going to do. You're going to minimize it. So I'm hoping that you'll go through the pain of Module 1 and Module 2 and you go, God, it sounded more exciting when Declan was talking about it, and no, stick with it, it's worth it. And then when you come out the other side, and then your second assignment at the end of Module 4 is you will be given, I'm not sure, there's different variations where you're given a company's performance for 3 years, or you're given 3 different companies and asked which is the best, which is the worst, would you give them credit, on what basis, blah blah blah. So you have to look at them intelligently and give us a reason why you would or why you wouldn't. Yeah, so that is the risk module, and to be honest with you, I'll be adding stuff, particularly over the next term. Once I get this Congress out of the way, part of what I'm going to do, particularly because of the economic times we're heading into, I am going to spend a lot more time revising the material for risk And so, you know, and anything that I do parallel to the course is optional. You know, I'll pose you challenges should you choose to accept them. So there'll be no marks, there'll be no nothing. And as I revise spreadsheets and stuff, I'll share them with you, because to us, you are the most important people in the world. So that is the 4 modules. This, I just put it up here. This is your workbook. So, for example, and this is workbook 1. So we give you 5 numbers. So, so expenses, liabilities, income, assets, and capital. And what you have to do is work out what their expenses are from that. Um, I'm sure you probably wouldn't be able to do it right now. That's why you have to read Module 1. So Module 1 goes through the accounting equation to tells you what goes where. And then, because sometimes we're dealing with incomplete information, so part of a job of a credit controller is to be able to fill in the gaps. So by understanding the accounting equation, you're able to, so I don't know what the capital is for this company, I can work it out because I know the formula. Do you get that? So these are the workbooks. Now you do not submit, you don't have to send in your workbooks for correction, none of that kind of nonsense. The workbook is totally for your own use. Now, Angelina, you have the answers
Yeah.
to the workbooks, and if you want to, you know, you'll share them or point them in the right direction or explain where the answers came from if you don't understand. You know, avoid the temptation of saying, oh, send me the solutions to the workbooks. You know, it's one thing, you look at the question and you look at the answer and it's obvious. You know, you look at a question and a blank sheet of paper and it's not obvious. So so work through it. That's my advice to you. And in each stage of the notes, you should be able to do test 15 in the workbook. Go to test 15, make sure you can do it without referring to your notes. And if you do, well and good. And Angelina has the answers for you if you're stuck or you just want reassurance that you're
Yeah, it's just part of your learning as you're going through it. Like the workbook isn't marked or anything like that. You know, it's not scored. It's only your tests and your assignments.
yeah. So it's just for your own benefit, and hopefully it'll help you on track. The short tests. This is actually the first short test. So again, like the workbook, you'll calculate the missing figure. So there your assets, that's your capital, that's your liabilities, that's your expenses. So on that basis, what's your income? So there's extracts and all that kind of stuff. And here, there's 2 parts to this short test. One is what is your closing, what is the value of the gross profit, and what is your margin percent. Now, that's a sneaky little one because there's a difference between margin and markup, which you're going to learn as well. And to me, I listen to the journalists on the business news, and sometimes they don't understand the difference and they just go down in my estimation. If you don't understand the difference, you shouldn't be standing up telling us what's going on. So hopefully you will understand the difference between margin and markup, and they're 2 totally different animals altogether. So that's kind of what it's going to look like, and there'll be 10 questions in each short test. You put in your answers, and guys, if you get it wrong, you get it wrong. What's important is you understand what you did wrong, and you're able to correct it. You know, because I know we all love getting 10 out of 10s. If you get 10 out of 10 in every test, then you're not learning. You know, so that's it. So be nice to yourself. So that's what your workbook looks like. That's what your short test looks like. That in terms of Angelina, yeah, well, I think we've covered all this. We're not going through it again. So that's the details. Revision session 5th of November from 10 to 12, and that will go through the trading profit and loss and balance sheet and adjustments and all the other good things that have to go into the mix to confuse you. And look, it will become clear. You know, some people just, they have this mental block where, you know, what was it? Mr. Tommy Cooper said once, he said, I knew I was going to have a problem with numbers because the first day I went to school, the teacher said 2 and 2 is 4. And then the second day I went in, she said 1 and 3 is 4. And I went, here. So some people just don't get it. You will get it, and that's our job for you to get it, and that's what Angelina's here for, and that's what I'm here for, to make sure that not only do you get it, do you understand it, then you can apply it, and have that knowledge going with you, and the confidence of that knowledge as well, which is great as well. So I'm going to stop sharing now, and I hope that's a whistle stop tour. I'll stop the recording because that is what we do.